Okay, so my name is Sam Seiden. I see a few familiar faces in here. Hello, everybody. What we're going to talk about today, obviously we're going to be looking at Forex charts, currency pairs, US dollar, and all that. Over the past many years, 15 years or so, I've traded just about everything you could trade out there: stocks, futures, Forex, and options. And but I started out on the floor of the Chicago Mercantile Exchange trading foreign currency futures. Even though I was trading futures, you're constantly watching the cash market on the board because they're both obviously moving tick for tick in each market. We'd be watching the cash market to see what the banks are doing, what the banks are bidding, what the banks are offering, and things like that. Constantly on the phone with banks, getting quotes, trying to make sure, identify times when the futures and the cash were out of line a little bit. We have many big clients looking for supply-demand imbalances, things like that, imbalances in the bid and the offer between the cash and the Forex. The cash and the futures. When I say cash, I mean Forex. And that was back many years ago. But make no mistake about it, the way that you make money trading today is exactly how you make or lose money trading back then, and way before that. Okay, it's all about two things. Number one, support and resistance, which in here we usually call supply and demand, or demand and supply, I should say. Trying to figure out how many buyers and sellers are at different price levels. If you can quantify with any general degree of accuracy how many willing buyers and sellers there are at different price levels, you can do very well trading. So support resistance would be number one. Number two would obviously be the trend. There's really a couple different types of traders. There's people that try to catch the reversals, the turning points, which is something I talk about a lot in here, looking at these supply and demand levels. And so we're trying to get into the move before the move actually gets underway. Then there's the other type of trader, which are more trend-following type traders that are trying to not catch the extremes, but they're trying to catch the middle of the move. Okay, so what we are going to talk about in here are actually both those things. And while I talk about supply and demand so much, sometimes I think way too much, identifying these turning points and bases and all that and rules, we'll take a little different approach today. Instead of just looking at the charts I usually put up here are just price, no indicators, no oscillators, no news, just price, quantifying supply and demand at the various price levels, looking for supply and demand imbalances and taking advantage of those trades. What we're going to talk about today, while some people can do that and like it, there's a much bigger group out there that is always looking to make things work with indicators and oscillators, because that helps take the emotion out of trading. It helps make things very mechanical. So we're going to look at it from that perspective today. We're going to talk about turning points and getting into the trends. Okay, I can tell you right off the bat that in the if you want to talk about the classes, I do stuff for we at Online Trading Academy we have classes that where again we're looking at taking trend type trades, and we're taking reversal type trades. But I can tell you the vast majority of people in those classes that I see anyway becoming successful do simple things like taking trend line breaks and things like that. Okay, we'll talk about trend line breaks in just a little bit. And for today, we'll go over 2 or 3 different things, and then as long as there's time at the end, we can look at any charts you want to and talk about whatever markets you want to. Fantastic day to be talking about these currency markets, because we're like right in the middle of some big turns here, which are great. So let's talk about trends for a moment. Again, the people that are going to make the most money trading in a trend are the ones that get in before the majority of people get in the trend, which means before the majority of people see the trend is underway. They get in at the beginning of trends when the risk is very low and the reward is very big. Okay? Then there's a whole other group that waits until that obvious trend is underway. Maybe they're using a moving average or higher highs and higher lows, things like that. Then they see the trend is underway, and then they try to get on board. That group is fine, and that's probably the biggest group out there. And if you do it right, you should be able to do okay, keeping your losses small and your winners bigger. Hang on to your winners. But keep in mind, that group is always going to provide income for the group that got in before them. That's how trading works. If you're new to this business, you have to think in those terms. Okay? The longer you wait to get into a move, your risk is going up, your reward is going down. Okay? Again, there's nothing wrong with getting in the middle of the trend, but you have to do it at the right time. So let's start with focusing on reversal points, for example. Okay? Let me get you another picture up here. Okay. So now, the type of entry we're going to look at right now is a way that you can, this is not the normal supply and demand talk we have in here usually. This is a way to use indicators and oscillators to accomplish very much the same thing, getting in when the risk is low and the reward is high. Is every trade going to work? No. That's why we keep our losses very small. We hang on to our winners. We need rules for that, or else it's going to be very hard to do it. Okay? So this is a way, again, to get in on a reversal before the trend is underway. Okay? If that turns out to be a trend, you're going to be in with the low-risk entry, and you will get paid from those that get in after the trend is underway. Okay? So let's take a look here. What I've got on the chart here is a Bollinger Band. Okay, Bollinger Bands. And I've got the Commodity Channel Index, the CCI, on the bottom of the screen. Okay. There are many ways you can do this. I'll show you one here, and we can talk about others. You don't really have to worry about the trend too much here. Don't focus on that. Okay. If you take a look, let me put a line on the chart so we can all focus in the same area. Okay, and I'll take a picture of it for you. Okay, so everyone see that line on the chart? Let's make sure we're still connected here. Often people are typing away, but okay, great. Just want to make sure. All right, thank you. So you can see the vertical line here. What we're looking for is prices to pierce that upper band. Okay. Now, just because prices pierce the upper or lower Bollinger Band, that is not an entry in and of itself. Okay? That thought process will break down the same way every oscillator breaks down. When prices move strong in one direction, you can pierce the Bollinger Band bar after bar after bar, and if you're taking the wrong directional trade there, you can really get hurt. So don't, just because the prices are piercing an upper or lower band, don't take that as an entry in and of itself. So in this case, you could see that prices pierce the upper band a couple times here. Once you pierce that band, you want to watch an oscillator like CCI or any of the others. You can put stochastics on here, you'd get the same thing. And as soon as CCI crosses back below that 100 mark, in other words, CCI has gone overbought, and it's actually gone overbought when the prices pierce the upper band. Okay, let it stay overbought. And you know what? If it stays overbought for a few bars, big deal. It probably means there's just a better trade right around the corner. That's not an entry. But when it goes overbought and then goes back below that 100 line, the overbought area, that's going to be your trigger for entry. Okay. Your stop, again, you can play around with this depending on what you want to do. But a good idea for a stop would be to be right above that pivot high, which in this case happens to be very close. An initial target, again, an initial target, not complete target, but an initial target can be that lower band when prices come back to the lower band. Another thing you can do is use that moving average that's creating the Bollinger Band as a trail stop. Okay, so one person I know that uses this strategy, they would get in when the CCI goes overbought, and then that's not when they would get in when it goes back below overbought. Okay, right where you have that line, the vertical line. Okay, they would get in right there. They'd put their stop just above the high of that, that pivot high there. Okay, the 162.70 here in the euro yen. Their target, they're going to get out a part of their position when price hits the lower band, and then they're going to use the moving average, okay, as a trail stop. So they would get out of the rest of their position a bit lower, where you can see prices go back up through that declining moving average. Why am I being so detailed with this? Because the people that have very specific rules and can follow those rules are typically, those are the people I see making money trading. I know I couldn't do it without very specific rules. At least I don't think I could. Okay. And the people that don't have rules, again, from my observations, okay, the people that don't have rules and can't follow rules are simply the people who provide income for the people that do have rules and can follow rules. Okay. From day one on a trading floor till now, what I witness is simply a transfer of accounts from the people that don't know to the people that know. Okay. All right. Question here from Pete: does this strategy work for other time frames as well? Absolutely. Okay. The things where while I see people turning this into a profitable strategy for them, what people will do, they'll take a simple strategy like this. The key is to take something like this, if you're comfortable with it, and make it yours. In other words, put it on the time frames you're comfortable trading it. If you don't like sitting in front of the screen all day, and you don't like being very active, don't do it. Use it on a 5-minute chart. Use it on something much bigger. Okay. If you're looking for more action, use it on a smaller time frame. Get your entries, stops, and multiple exits. Keyword multiple exits in there. Okay. Make sure that you're getting out of your losses quick. Make sure that you're hanging on to your winners. Okay. Remember, there's 4 outcomes to any trade: big win, big loss. Okay. Small win, small loss. Right. I guess the other one's a break-even trade, but those first 4, as long as we eliminate the big loss, we can live with the other 3, right? Okay. And if you're a trader, that's what you'll be doing, is living with the other 3. Okay. Okay. Let's just scroll around here, see if we can find some other entries. Find a long for you. You can go to a bigger time frame here as well. Now, remember, this is the type of strategy that is attempting to catch reversals. In other words, getting into the trend before a new trend is underway. Okay, this is not a trend following type strategy. Okay, so let me get you another one here. I just put this on a bigger time frame. Okay, now we're going to talk about something very very important here. And again, I primarily trade for a living, and I do some courses and write some content for some of the magazines out there, and then for Online Trading Academy. So you always get it straight from me. I don't have any relationships with a brokerage, and even my compensation for teaching classes has nothing to do with how many people are in the class. So you always get the straight answer from me. Having said that, I do not use this strategy, but I see people using it, and I know someone that uses it and does pretty well with it. And I know the indicators allow you to take emotion out of your trading, which is key. So I just wanted to share it with you. The other thing that we'll talk about here before we move on is, let me show you. Okay, so here I just put the same market. We just put it on an hourly chart. Okay, and you can see here to the right, we've pierced the upper band. Okay, and but when you pierce the upper band, the CCI, that's when the CCI goes overbought. It's not an entry. When on the next bar you come back through the upper band, and then CCI begins to cross. Okay, but in the real world, where I have that line, until that bar closes, CCI may or may not cross back below that that upper band, that upper 100 area in the CCI. Okay, so does everybody see I have that line, that vertical line on the red bar? This is important because when you start doing this, you'll see the realities of indicators and oscillators. So if that red bar was, let's say it's an hourly chart here. Let's say that bar looked as it does here for 55 minutes out of that 60-minute period. And then let's say in the last 5 minutes, all of a sudden a lot of buying came in. Well, that CCI picture, the way it looks right now, what you're looking at, all of a sudden will turn up. So if you enter that thing premature, you know, what might be an entry for 55 minutes out of the 60 minutes, that could go away in that last few minutes. Does everybody understand that? It's a subtle point, but it's very important. Okay? So in reality, okay, let me show you. In reality, I just moved the line to, it's going to be a lot, here's where when you're going to see that you do have confirmation. Okay? All right. So you're entering on the next bar, you're giving up a little bit of the, you know, your stop's a little bit bigger, you're cutting into your reward a little bit, but now you have a mechanical strategy. Okay? Okay. Now there's no just, Len, I see your question there. Okay, don't worry about, remember, we're talking about two specific things here today with regard to trends. Getting in at the beginning of the trend, before the trend is obvious, really before you have a trend. So catching the reversal to be one of the initial people in that trend. And then the second part of it is, let's say you don't do what we're talking about right now, and you see that there's a trend underway. We're going to talk about that in a minute, how to get into the middle of a trend. Okay? Which again, there's nothing wrong with that. We just have to deal with it a little bit different. So what we're looking at here, don't worry about the trend. Don't worry about the slope of the MA or anything like that. You're catching turning points. Okay? That's why you have to keep your stops really tight. And you want to hang on to these. Okay? Like this one here. In reality, when we enter this, if we enter on that red bar right there, you don't have a downtrend underway yet, right? Okay? But if you're right, if you catch the turn and it works out, now there's a downtrend underway. Okay? So everybody else that comes in and says, hey, look, there's a downtrend now. We want to get on board because we're trend followers and we have a downtrend. We have the picture of a downtrend, so it's okay for us to start selling short. Well, guess what? If you being the one that took this reversal up here, you're a part of that picture, that invitation that goes out to everybody else that says, hey, come on in now. It's okay. We have a downtrend. So they're going to come in and pay you for something you already did. Okay? Again, I'm not saying these reversals are any better than trend followers, or trend followers are any better than this. There's two different ways of doing it. Okay? You could do both if you want. All right? Okay. Any questions on that? And again, you can. I don't have a ton going on this week or next week, so I've been catching up on my emails pretty good. So you can always send me more emails on emails if you have any more questions on this or things like that. But let's go over to a different chart here. Okay, and now your stop. No, someone's asking here if you put your stop above the upper Bollinger Band. What I was saying in here is putting your stop above the pivot high. So look at price, not the band. However, if you are doing this for a while and you see that if you look back on, say, your last 10, 20 trades, and you say, you know what, it's working out okay for me, but I probably didn't need to put my stop above the pivot highs. I'm probably okay putting my stop above the upper Bollinger Band or below the lower Bollinger Band. That's something you're going to see in time, and that's how, what I'm saying is you'll take, a very basic strategy and make it yours. Okay? I'm not sure what you mean there. Where is our limit? If you're talking about target, remember we were saying you want to try to hold these to the lower band and then maybe use the moving average that creates the band as a trail stop. Okay. Yeah, for this I wouldn't focus too much on the slope of the Bollinger Bands. Okay. Okay. And you can have this set up. It depends what platform you're using, Pete. You can have this set up on different workspaces. If you're you can set these charts up with whatever pairs you want to look at. You have the strategy on the chart and just really set that up as one page. That could be your analysis page. Okay. Okay. All right. We'll get back to some of these. So now let's take a look here. Actually, let me grab that chart again for you. So we've talked about catching the reversal to potentially be a part of the trend. Okay. But let's say you don't want to do that, and you just want to kind of sit back and get involved in trends that are well underway. We've talked about this strategy I'm pointing out here a number of times. I believe this is also in one of the pre-recorded sessions that you can find on the fxstreet.com website. Okay. What we want to do here is put in a moving average to help us identify the trend. Here we have a 50-period moving average on the chart. Okay. Again, I made it a 50. You can make it something smaller if you like. Again, when it comes to trading and things like that, I tend to be Mr. Conservative with this stuff. I've been doing it for a long time. I've got a very specific set of rules that I follow, very simple. Managed accounts and any trading I do, I'm always following a very strict, simple set of mechanical rules based on the pure laws of supply and demand. So I will always go with the conservative side with this. Of course, when the odds are stacked in my favor and the risk is small, the reward is big, I will get as aggressive as the next person. Boyke, yeah, this is just a 50 simple moving average, not exponential. You could use exponential if you want. It's just going to hug price a little bit closer. Okay. But what you want to do here is there's two parts to this, right? Number one, we want to know what the trend is. Okay. We now want to know what the trend is, and we want to be sure we know what the trend is. So we don't want to do. In other words, for uptrends, make sure the moving average is clearly sloping up. For downtrends, make sure the moving average is clearly sloping down. Okay? Not something that's borderline flat. All right? Okay? So the next thing we want to do, let's say that we see, like in this picture right here, we're looking at the euro against the dollar on a small time frame. Let's see that we see that the moving average is clearly sloping down. Okay? Once we see that the moving average is clearly sloping down, what do we want to do? Do we want to be a buyer or a seller? So the moving average is clearly sloping down. Yeah, we probably want to be a seller. Okay. I saw that first quick question in there from Miami Greg. Okay. Take these, again, make this very rule-based. Okay. And yeah, when you switch time frames, what's one trend in one time frame is going to be a different trend in another one. So again, it's got to be very, very rule-based. Make sure that you're trading whatever time frame you're looking at. Trade that. If you have a system or strategy like this with indicators and oscillators, make sure you trade it for that specific period. Okay. All right. Okay. All right. So once we know that the moving average is sloping down, we want to be a seller. Who do we want to sell to? This is probably one of the it's probably one of the most important things in trading. Who are we selling to? Right? Who do we want to sell to? Obviously, we're gonna sell to a buyer. We want to sell to someone who probably consistently loses. Right? We don't want to sell to a smart buyer. We want to sell to a ill-informed buyer. Okay? I'm sure we've all been an ill-informed buyer or not a smart buyer at one point or another in some part of our life. Maybe it was buying a car or a home or anything, right? We've all done it. I've done it. I bought a car once that I completely overpaid for. Okay. Anyway, we want to find the people that do that consistently. The people that do not, know what they're doing. Okay. So what does that ill-informed buyer look like? Well, keep it real simple. Someone who's, let's bring it back to the laws of supply and demand. Someone who buys after a period of buying and buys into price levels where there's good evidence that supply exceeds demand, okay? That's not a consistently profitable buyer and seller of anything, okay? The laws of supply and demand guarantee that, all right? So we want to find someone buying after a period of buying in the context of a downtrend, okay? What is a downtrend? It's a market where prices are at levels where supply exceeds demand. That's why they keep falling. They will stop falling once they reach price levels where demand either equals or is greater than supply. Okay? Now, in this case, again, we've already identified that the trend is down. So we want to find someone buying after a move up in price in the context of a downtrend. A smart buyer and seller of anything would never do that. Okay, so if we put a couple, so that's why we bring in the CCI. We bring in the CCI to show us the overbought and oversold readings. Okay, so keeping this very mechanical and very rule-based. Okay, when the trend is down, we want to ignore every oversold reading that CCI or any oscillator gives us. Those will all appear to be buy signals. But when the trend is down, we do not want to be buying, so we ignore every one of those signals. And you're going to get a lot of them. Okay. However, we want to take the very few overbought readings that CCI gives us as sell signals. Okay. And let me put some in here for you. Again, we're not going to pick and choose and things like that. We are going to take... we're going to keep it rule-based. If one doesn't work out, we just stop out of it. If it works, okay. Small losses, hang on to your winners. So in this chart, we get, how many entries do we get before I show you? Who wants to tell me how many entries we get? Yeah, I see 3 as well. Okay. Now you can see, if you look at my vertical line and look at it down at the CCI part, okay, you can see it looks like I'm shifting it over to the right, right? Where maybe you might think I should move it over to the left just 1 bar. But again, I'm giving you the reality version of trading, okay? If you're at an expo, a trading expo or things like that, or you're talking to someone who takes advantage of the fact that trading education has very little to no regulation around it, they'll probably show you the entry 1 bar to the left. But this is the reality version, okay? I could easily shift that line over to the left 1 candle and make these look great, but you're going to go try this on your own, and that's not going to work, okay? So in reality, this is when you're going to get your sell signals, all right? Okay, and again, here, the logic, okay, why, who are we selling to? We're selling to someone who's buying in the context of a downtrend, which is not smart, period, but they're buying after a move up in price. And they're buying when the oscillator is telling us, giving us an overbought reading, right? In the context of a downtrend. All right. These are not smart buyers. They don't understand completely how markets work, and they don't understand how you make money buying and selling anything. They may understand it. They just certainly don't know how to apply it. Okay, buying in these areas is like walking into a car dealership and saying, "Hey, that $30,000 car over there, I like it so much, I want to pay you 40 or 50 for it." Okay. All right. In the real world, you would never do that. However, when it comes to trading, emotions come into play. People start drawing funny pictures and thinking it's more of an art than anything else. Okay. If you're like me, coming from the order flow side of things, remember I started out in this business handling institutional order flow. You see that nothing here is random. This is all based on pure numbers, and it's people, very few people that know, taking money from the vast majority of people that don't know. Okay. Make sense? Any questions on that? All right, let's move to different area here. And what we've been looking at here are really shorter term charts. I'll pull up a bigger time frame chart for you. And remember, what we're talking about now is a way to get involved in trends that are underway already. Okay. There's a daily chart of the euro. We put the lines that you would be getting in on that candle, ZBYS there. You'd be getting in the line I'm putting the candle on. That would be your you'd be your entry candle there, because once the candle just before that closes, that's when you have confirmation. Okay. There's things you'll notice with the moving average. You probably notice that when prices is, for example, for downtrends, when price is below the moving average, things are obviously going to be very weak. When they're above the moving average, that's when a lot of your entries are going to come on the short side. But you'll notice things like that. But I wouldn't worry about making that a hard rule or anything. Okay. Taking profits, again, you can if you're risking, it all depends on what time frame type of trader you are. But if you're risking 10 pips, you probably don't want to start taking profits for at least you hit your 20 pip profit. Okay, right? And it's very important, and that's just 2 to 1. Hopefully, you can hold out a lot of your winners for more than that. Okay, I know someone very well who trades, and this person is right 8 or 9 out of 10 times. They hardly ever lose, but they don't make money. Okay, it's because they are the master of taking very small wins, but when they have a loser, they tend to hang onto it a little bit too long. Okay, so while we're focusing on really the charts here and when to get in, when to get out, where to put your stop, things like that, it's crucial that you learn to get out of your losers quickly and hang on to your winners. Okay. All right. So here's a daily chart of the euro. Okay, and we have we probably have a couple entries here. Again, once we see that the moving average is clearly sloping upwards, so we haven't caught the turn in price, right? Maybe we've missed the big turn, and we see a trend is underway, right? We can easily jump onto that trend, okay? But if we do that, we want to make sure that our entry, again, is low risk, high reward. not only low risk, high reward, but we want it to be a high probability trade. To take a high probability trade, we want the person on the other side of our trade to be taking a low probability trade. In this case, we're buying in the context of an uptrend. We want to buy from a seller. Which seller? We want to buy from a seller who's selling after a drop in price in the context of an uptrend. Okay? That is not a consistently profitable trader. Consistently profitable traders don't sell in uptrends, and they especially don't sell after a drop in price in the context of an uptrend. Okay? So to identify that novice seller and take the other side of their trade, okay, we use the moving average to tell us what the trend is, and then the oscillator to give us that mechanical entry. Okay, Johnny's pointing out an entry here in August. Yeah, let me see here. On my screen, I have it scrunched up a little bit, maybe too much. Okay, yeah, I guess we can, let's put that one on there too. Okay, and remember, just before August, maybe like July there, we cannot say that the moving average is sloping up. I'd say towards the end of July is when we can really say that, you know what, the moving average is sloping up. We've got a trend underway. Okay, now, again, I keep saying this, not every trade is going to be a winner. In a trend following strategy like this, it's crucial that you hang on to your winners and get out of your losers quick. Because what's going to happen, this picture here is very, very typical. You'll typically have, usually I would say on average, if you're doing it right and following the rules, you can have 2 to maybe 3 winners in a row in the trend. But then that next trade will often be a loser when the trend is changing. You're going to get that same signal, but instead of price continuing, it's going to reverse. That will be your stop out, your loser. Okay. Again, the best traders out there that follow their rules, they're not going to care about their losses that much. What they care about is that they're following a consistently profitable strategy that makes them get low risk, high reward money over time. It's all about following, having some low risk, high reward rules. Okay. I wouldn't. Everybody see this question here? How can one filter out the bad long entry at the end of July? Again, I don't want. Please don't think I'm picking on anyone here, because I'm completely not. But someone who's been trading for a while, who does well, they would not worry about that. They wouldn't try to filter out that loser, because they realize that you're going to have losses. And if you're handling your average win to average loss the right way, they're not going to care about the losses, because the losses are small and the winners are big. Let me ask you guys this question. What if the casinos in Las Vegas tried to filter out their losses? Would they have any wins? Would they be able to operate their business if they went in and tried to figure out how to filter out the times when they lost money? Okay. Does everybody understand my point there? Okay. Imagine if Las Vegas went in and adjusted and constantly was adjusting their trading plan or their business plan. Okay. There are things you can do, like yes, raising your stop to break even after a certain profit threshold, things like that. Okay. And remember, just back to Las Vegas thing for a minute. They know they're going to lose. They're going to lose every day, but over time they win, and that's what's important to them. Okay. Does everybody understand that? I'm not trying to say this is just pure gambling here, but we're speculating. Okay, when you go to in a casino, you're speculating. When you When Pepsi or a major company like that buys commercial time on a net TV network, they don't know exactly what they're going to get for it. They're speculating just like we are. They're putting money out there hoping for a return. Okay. The key is to be a very astute speculator. Make sure that at the foundation of your trading, you're constantly focusing on who is on the other side of your trade. Look at the chart, and the chart will help you with that. Are you selling from someone who's buying after a drop in price in the context of an uptrend? Right? Are you selling to that person? Are you buying from someone who's selling after a drop in price in the context of an uptrend? Okay? Just ask yourself those questions. Telling when the market is changing from oscillating to trending, all that. Again, what we've done here today is we started out with a simple strategy that can help you identify turning points that ignite trends that show you where the beginning of the next trend is going to be before it happens. Okay, and then we went into a little simple strategy that can help you get into a low risk, high reward entry while the trend is underway. Okay. Okay. Speculating when trading with a plan? Yeah, you're always speculating. We just want to make sure we're putting our money on the line when the odds are stacked in our favor and the risk is low and the reward is high. Okay. And I know we're out of time here. We have to probably supposed to wrap this up a few minutes ago, but let me put my email address in here. Okay. And there it is for you. And I have lots of material, little chunks and pieces I can send you. And thanks a lot, and have a great day.